So you guys recently raised a fund. They recently raised a fund, so breaking news.
Yeah, we raised about a $350 million fund. The first time I did anything at Kavu, I looked at the financials and someone used the word burn. And I was like, what is that? Like, there's no profit in this business.
If you're looking for like a 3 or 5x, then it's kind of like, okay, I don't want to, give this guy 50 million of primary at a 200. And then it's like, it's got to be 600 million. It's a big exit.
So you're a minority, you're not majority. You can't definitively move the needle on whether a deal gets done or not, even though we have all the rights you expect from a minority investor. And you've given the founder significant life-changing money.
What are the types of things that you're going to want to understand more and the things that I should know about my business that I might not? Like, what's important to you guys as an investor?
If it's not efficacious or doesn't taste good, that's sort of like the very first piece of the equation for us. You can have great gross margins and an amazing team, but if we don't actually believe ourselves in the business as consumer investors, it is hard for us to get behind that investment.
All right, ladies and gentlemen, welcome back to another episode, a Byside episode of the program. Today I have my dear friend with me, Robbie Patterson. Robbie, how are we doing?
Doing well. Good to see you, Drew.
Good to see you as well. Robbie and I were hanging out at Sophia's last Wednesday or Thursday, and I think we had this pod on before then, but either way, always a pleasure to see your beautiful smiling face. I wanted to have Robbie on the program here today because I kind of realized that I haven't had too many sort of buy-siders on. I think I had, I had Wayne from BMG and Tara from Main Post, but I think I needed to get a little bit more of the private equity going on here. So, Robbie, do you mind just kind of giving the audience a little bit about you and your background and what you're doing today and kind of how'd you end up here?
Yeah, and it's a great intro and transition to my kind of whole story. I actually did start off properly on the buy side prior to Astō today, but yeah, my career's been full circle. Kind of your traditional finance career was doing investment banking at William Blair, the consumer.
Is that in Chicago?
In Chicago, yeah, which I think is actually how you and I got set up initially back in the day, and
Yeah.
your prior life. You'll still stay real close to the William Blair guys. And yeah, I worked on a lot of interesting deals that leaned a little bit more towards the better for you natural side, right when like
Okay.
the inflection point was changing, call it 10 years ago.
Yeah.
And that really teed me up nicely to ultimately get on the buy side. I worked with the William Blair team on a business called Gold Standard Baking, which was
Okay.
an Arbor Investments deal. And that was
Okay.
my first taste of Chicago consumer, specifically food and beverage.
Fun fact, my dad's roommate from college is the CEO of Arbor, I think.
Oh, nice. Yeah.
And
Yeah, it's great. Yeah,
yeah.
that's great
Anyways,
firm. Kind of,
irrelevant.
yeah. I mean, they've done a really good job. Like I think I was there when they were on Fund 3. They might be on Fund 5
Okay.
now. That was my first taste of the food and beverage side of the investing equation, and I immediately loved everything about it. With the exception of when I ultimately went to Arbor. We focused a little more on the manufacturing side and a little less on the branded side.
Oh, so you ended up working at Arbor.
Yes. Yeah.
Okay.
So
Got it.
started at Blair, went to Arbor. So I was on the private equity side at Arbor. Got a lot of great exposure with kind of the nuts and bolts of investing, especially, like I said, on the manufacturing side.
Yeah.
It's like I cut my teeth, understood what was happening on the back end, and that ultimately allowed me to eventually get more into the VC growth equity stage with branded consumer businesses, which
Yep.
candidly, like just from a personal perspective, was something that was interesting to me my whole life. I've always loved, fashion, apparel, huge foodie, always kind of seeing what the next trends are in food and beverage. And then as I've gotten older, I've leaned more and more into supplements, longevity, and,
Yeah.
eventually age catches up with you. So that's a huge focus for me now these days as well.
Yeah, it's a hot space. So how long were you at Arbor for?
Yeah, I was at Arbor just for 2 short years before we went to business school.
Okay.
And that's how I got hooked up with Clayton, Christopher, who I work with today, and Brian Goldberg. So I went down to Austin, was there at UT for a bit, which I think we all know today that, Austin's become such a hub for the ecosystem that is CPG. So
Yeah.
I didn't really appreciate that being a Midwest guy. But man, being in Austin, so much exposure to interesting brands right in our backyard. And
Yeah.
that's given us like a really nice opportunity to just do a lot of cool work with businesses just in our backyard.
So tell us, how did you yeah, I guess I never even really asked you this. Like, how did you originally meet Clayton, and who is Clayton, and how
Yeah.
does he yeah, tell us about that whole relationship.
Yeah, it's funny, like, I knew who Clayton was, tangentially just from being in the space, and for those that don't know Clayton, I think most people in CPG do, he's a 3 times over founder with exits, so Sweet Leaf Tea, Deep Eddy Vodka, Waterloo Sparkling Water.
Yeah,
He
he's good.
yeah, he's done well. So
Yeah.
I knew who he was from the operator lens side, and then I had really more of appreciation for him from his perspective on the investor side when I was down in Austin, for a short stint at Kavu Ventures when he was still at Kavu. So
Okay.
still stayed really close to kinda, the majority of the guys that had been at Kavu, and, still so are there today, but, it's been nice to see everyone kinda splinter off into their own different funds and do
Yeah. 'Cause Clayton started Kavu,
Yeah,
right?
he was one of the
Yeah.
original founders, him, Will,
Yeah.
and Brett, and that's where I started working with Clayton and the Austin team, and to your point, quickly learned that, his vision and understanding for the way founders, view a business was very unique. So
Yeah.
you can get into the numbers all day, and for me, actually, it's a story I've told multiple times, but coming from private equity, you know, we care about profitability, EBITDA, gross
Yeah.
margins. Growth is great, but, you can do an LBO in a business that has, the right profit. And like, the first time I did anything at Kavu, I looked at, the financials and someone used the word "burn," and I was like,
Yeah, you're like,
"What
"What?"
is that?" Like, you mean there's no profit in this business? So I kinda had a full circle moment, in my career where everything used to be, profit and
Yeah, yeah.
the right debt and LBO, style investing to, chasing growth and not worrying about the profit. And of course, full circle now at Astō, we're only investing in profitable businesses with strong growth. So
Yeah.
I think we're playing in a really unique spot, in the investing profile in CPG today.
Yeah, so before we jump into that, just kinda, like, walk through this. This is super classic. This is, like, probably, like, what I would have ended up doing if I didn't, like, start going into, like, the dumb and hard part of things, but,
Yeah,
it's like banking, private equity, and then, like, into,
yeah,
call it venture, call it growth, whatever you wanna call it. And so you end up, you, like, interned at Cavu, I guess, for a
yeah,
little bit
yeah,
while you
yeah.
were in
So I was like a
VC.
business school intern,
Got it.
and to your point, it was sort of an inflection point for me because you could either do the traditional path, like
Yeah.
that finance path, which feels like a little more cookie cutter. Then there was an opportunity for me really just to jump on the bandwagon with Clayton, and we were doing family office style investing for almost 4 years before any sort of, proper fund came to fruition.
Yeah.
So I always, what this is, I'm sure founders will laugh at this because 'cause they'll say that, this is relatively low risk, but for me at least, it was a bit of a risk because,
Yeah,
I'm
for
like,
sure.
"Hey, let's just do myself and Clayton family style investing, see where it goes." And obviously things have gone really well, and we have,
Yeah.
a really strong portfolio, but for me, in my own way, it was kind of an entrepreneurial move, even though
It was. I mean, it's just like you guys are a small group, and even though, I mean, there's riskier things to do, like, I respect it.
Yeah.
So you said okay, so Cavu, after post Cavu, it's like family office style investing, sort of you, Clayton, like maybe some other guys, but,
Yep, Brian
um,
Goldberg.
Brian, and what's Brian's background?
Yeah, Brian's got a great background, and I think that's kinda what makes us unique. So Brian, he's been on the investor side and also has been on the operator side. So he actually met Clayton, like, I don't know, 20 years plus now ago. He was the CFO, when Clayton was running, Sweet Leaf Tea. So that's how they
Yeah.
met. So they had, like, a
Um,
really good relationship between the 2 of them on, like, the operating side, and that's obviously led to a really unique angle on the investing side. So Brian, also most notably was with, Skinny Pop, and took
okay.
through the process to go public and ultimately, was bought by Hershey.
Yeah.
And then subsequently, Brian started a VC incubator engine called Redbud, was doing some interesting stuff while Clayton was doing the
Oh,
Kavu.
I've heard of them. Yeah, yeah.
Clayton was doing Kavu, and then, fast forward a few years thereafter, and kinda all has come together and
Yeah.
fruition, so to speak, with Astō today.
And so you spent 4 years doing, like, the family office style or whatever, like, what happened? What opportunity did you guys see that made you wanna presumably raise outside capital and formalize and call it Astō, and what does
Yeah.
Astō mean, actually? Why is it called Astō? I don't even know.
Yeah, it's like, the Latin stem for to assist or to help.
Okay.
So, yeah, we just wanted to make sure we had something that
I
was
like it.
yeah, it was something that was simple, clean, and we had
Yeah.
the just a one-word name. So, but back to your, what was your original question? I think was just with respect to
Like, why not just keep going along with, like, the
our
family
family
office?
lifestyle. Yeah.
Yeah, like, like, what made you guys wanna kind of formalize it and kind of plant your flag in the ground?
Yeah, so I think what the most interesting part, there's 2 pieces of the equation here. There's a lot of interesting reasons why you would continue to do, family office style SPV investments. On the pro side of the equation, we're able to play across all stages of investing,
Mhm.
be involved in, businesses where we could write a $3 million check to as large as a $100 million check.
Yeah.
So I feel like with a fund, you have a more narrow mandate oftentimes. Family office style investing kind of allows you to be nimble, flexible, and go out to, individual
Yeah, you
LP.
can do whatever you want, yeah.
Exactly.
Fun. Yeah.
Um, Now the downside of SPV family style investing is, as we all know, earlier stage businesses will often require reserves or pro rata or additional funding. And if
Yeah.
you can't just hit the capital call button, then you got to go back out and essentially, if it's a good
Right.
story, usually it's easy, but sometimes you get in some turmoil. So I think it was one of those situations where we had enough recent deals in the growth equity stage where we felt like that was really where our strength was.
Mhm.
We did have some great, outcomes that were more VC oriented, but generally speaking, we felt like if we could just have a thesis that was oriented around growth equity, 50 to 100 million plus in revenue, profitable, that muscle was very
Yeah.
strong, and we'd seen that with a couple different recent businesses in our portfolio.
And so let's double click then, like, on the thesis for Astō, like, you mentioned a little bit sort of like the range, but, like, talk to me a little bit about, like, what, like, kinds of companies are you looking for? Like, is there a theme? I mean, you mentioned sort of the financial profiles a little bit, but broadly speaking, like, if you were talking to, like, a potential, like, LP, what's the wedge that you guys kinda fit in? Like, why is there alpha where you're playing?
Yeah, yeah, I think, like, the biggest thing that I've seen is, like, there is some asymmetrical upside in the growth equity stage. The businesses that we're looking to invest in, they're far enough along kinda that growth equation where we believe they've removed any sort of, like, binary risk with
Yeah.
with respect to, like, could someone buy them, whether it's private
Mhm.
or strategic. And then what we're playing, which is relatively unique, although you've seen a few funds now lean further into this, is minority investor, opportunistically would go majority, but minority investor with the vast majority of our actual invested dollars going to secondary as opposed to
Mhm.
primary. And I think that's, we're chatting about this over drinks.
Yeah, yeah.
What you don't realize until you kinda, like, see this a lot is oftentimes it's the founders that have been at this for 6, 7, 8 years. They've never been more motivated to continue going through the process and get you to an eventual exit, but
Yeah.
sometimes taking chips off the table and having that, like, opportunity to hedge against any risk with all the liquidity tied up to date gives them even a larger, motivation, and
Yeah.
as a partner with these founders, it's really exciting because now all of a sudden, like, "Oh, I can buy this house," or I can feel more secure with my family, and I can now execute with full certainty and clarity that I'm gonna make
Yeah, I can take the big swing. Like, I think it's interesting because I mean, I obviously talked to a lot of people in this space. I haven't necessarily met anybody. I didn't so I mean, we talked about this, the other week, but I didn't realize that it was the majority of your invested dollars were going to secondary. Because I mean, people do it often, but I don't know anybody that's part of their, like, core strategy.
Yeah,
Uh,
and again, I think part of it just comes from the comfort of having done, 10 SPVs, family office style investing.
yeah.
LPs and other, smart people, when they press you on it, they'll say, "So you're a minority, you're not majority. You can't, definitively move the needle on whether a deal gets done or not, even though we have all the rights you expect from a minority
Yeah.
investor, and you've given the founder significant life-changing money," which all theoretically are red flags, but if you go back into our history, um, time and time again, those founders are wired in a way such that they wanna win, and they wanna
Yeah.
win as part of a team, and usually, we joked with you about it, like, you can't buy something with stock in Iris or,
Oh,
wherever. You
trust me, I know.
you still need actual cash, and,
Yeah.
it's unbelievable how many times that we've seen this where there's, like, an inflection point switch, and these businesses tend to do a lot better when the founder feels secure, and
And, by the way, interests are just more aligned,
interests are
right?
more aligned.
It's like
Mhm.
if you're gonna tell them like, "Hey, man, like, I need you to come carry me," I don't know, I forget, like, what you guys are. specifically trying to underwrite generally speaking, but like call it like 3 or 5x.
Right, exactly.
Yeah, so like if you're looking for like a 3 or 5x, then it's kind of like, okay, I don't want to, give this guy 50 million of primary at a 200, and then it's like, it's got to be 600 million. It's a big exit. Like what if if I can invest secondary for a little bit cheaper and
Exactly.
everyone's yeah, I mean, so like to
Yeah,
me, yeah,
and that's a great point too, that, like, I think a lot of founders, until you get to the point where you're at, the stage you can talk to someone like ourselves, don't really founders are wired to always, solve for the highest valuation, least amount of dilution, but there comes a point along the way where you're like, "Actually, the most valuable piece of the equation here isn't the valuation as much, it's, am I with the right partner to get me to the exit? Do they know the
right,
strategics? Do they know the game plan, the blueprint?" And you hit it spot on. We found ourselves getting into a lot of deals at a discount, so to speak,
yeah,
but we feel good about it, and so do the founders, and it's a nice partnership. It's a nice way to start the partnership as well.
100%. One side question, because this is like curiosity. What's like the typical common stock discount? Oh, some people like ask
Yeah,
me this usually.
it ranges drastically. I would
Okay,
say, like, if you just ask, like, an investment banker or someone that's, deals in the secondary market, assuming there's not too much structure on top, like, I'd say anywhere from 10 to 25%, but 10 to
okay,
20% is probably the range.
yeah, yeah.
And it just depends on the stage and, how scaled the brand is, but yeah, 10 to 20% is what you usually see.
Yeah,
Mhm.
that tracks. And you mentioned at the earlier something interesting that I thought was like, which is like the brand's like sort of de-risked from like a binary perspective in terms of like somebody could buy it. Like, give me a little bit more on that. Is that like a revenue threshold or profitability threshold or
Yeah, it goes back even to, like, our discussion on, asymmetric upside or alpha. Like, we're willing to forego the earlier stage deals where you might have more upside, where maybe there's like a 10x in there,
Mhm.
because we want to be able to invest in a business that either opportunistically we've gotten into, because they weren't quite where they needed to be with, like, a channel to exit,
Yeah,
um, and or sometimes we'll find ourselves in positions where they're almost dual pathing, selling the whole business and or bringing on a partner. So
yeah,
I think when we talk about, like, binary risk removed, almost every business we invest in, they probably could just sell the business when we invest in them,
yeah,
and that gives us, a lot more peace of mind, and the way we're looking at this in terms of just, like, the general opportunities out there and, like, alternatives or VC or private equity is we can tell our investors, like, we have pretty good downside protection irrespective of being a majority holder, because we
right.
feel like if we had to turn around and sell that business the next day, we get people back at least their money.
Yeah, and that so that goes hand in hand then, like, sort of with the secondary approach, right? Because
Exactly.
it's like, yeah, like, why wouldn't they just we can give them some liquidity, but, like, we can get a higher, return sort of at the end
Yep.
of the day. Yeah, so that makes sense. So
And one thing I'd like to add too, Drew, is, like, it's not talked about as much, but there is also, like, this degree of the sweet spot being very very narrow for us, because we need to be able to at least see on the upside case, like a 5x plus,
yeah,
love it if there was an 8 or a 10 in there, but that narrows what the valuation, is that we invest, with companies, and
right.
obviously, you're looking pretty closely at what the universe of strategics and, the buyers, are paying. So I always joke about this. There aren't many diamonds in the rough out there for us. You kinda know the businesses,
Yeah,
that are in that, range. So a lot of this also has to do with, our ability to help these, businesses either bring on the right executives such that they can go public or be bought by a strategic, or just manage a process
yeah,
over 2 months and give them the playbook so that they, mitigate any risk with respect to not doing what they should do to get where they
yeah.
be on the exit side.
Okay, so I get it. So you're chasing these, like, relatively de-risked brands. The strategy is to, like, kinda get in as a minority, probably on, like, a secondary deal. Um, and so you guys recently raised a fund that nobody is talking about, I guess, but they recently raised a fund. So breaking news, you heard it here first.
Yeah, that's our style, under the radar.
Yeah, yeah. So kind of like so that's the strategy. You raise the fund. How much did you guys raise? How many investments are you looking to make? What's the check size? Like,
Yep.
if I'm a founder listening to this, like, what should I know about Astō from that regard?
Yeah, no, appreciate having the mic on this too, so we can get the word out. Yeah, we raised about a $350 million fund. We closed the final tranche, September of last year, and to your point, we've hit upon it a few times, relatively, concentrated and narrow approach. So we have 3 investments today.
Uh-huh.
Excited about all 3 of those. One's Oats Overnight, Clean Skin Club, is we closed last year, and then we're about to announce a new one in the, personal care beauty space in the next couple weeks. Kind of classic CPG verticals. So VMS,
Yeah.
at food and bev, personal care, beauty. Above all, I'm sure nobody will be surprised, but we love seeing strong gross margins. And then,
What's a strong gross margin?
yeah, I mean, it depends on the category, of course. There's a reason we're always drawn to, beauty and personal care and self-manufactured businesses. So, food and bev, like if you're self-manufactured, you could be above 55, 60%. That's like best in class.
Yeah, I was gonna that's high.
Yeah, exactly. So you don't usually see that. But if you could be in the 50-ish range plus in food and bev, that's amazing. And then, VMS, beauty, personal care, we have businesses that are as high as 85, 90%. And that's music to our ears.
Yeah.
But back to your initial question, like, yeah, part of the Asta thesis is we have a lean team, but we only want to have, 7 or 8 portfolio companies. So
Mhm.
when we do invest in a business, most of the investments we've been, developing the relationship with those brands for almost a year. In the
Yeah.
case of Oats, I've known Brian Tate now for 4 years. So,
Mhm.
we really wanna, like, roll up our sleeves, take a board seat or 2, and, what ends up happening is, like, we are tracking a lot of these businesses for several years before we actually invest in them. So,
Yeah.
you're not just stumbling upon these. It does take a lot of time and effort to just, understand kind of the trajectory and what the upside is.
Yeah, I mean, it's the long sales cycle.
Yes, exactly, exactly.
And so understood on, like, the categories and the gross margins, when you guys, like, start to get to know a company and you kinda start to dig in, like, to the extent that you can, walk me through a little bit about, like, if I'm a founder, and I start chatting with Astō, like, what are the types of things that you're gonna wanna understand more and the things that I should know about my business that I might not? Like, what's important to you guys as an investor?
Yeah,
Sort of, need some more,
I
I want
think, like,
more.
one of the two things that I think that are not spoken about as much these days as they should is, at the end of the day, like, we're investing in the founder and the team.
Mhm.
So, in certain opportunistic scenarios where it makes sense to bring in a new key executive, whether that's to run, like, retail or someone, overseeing, like a CMO, that
Yeah.
makes sense, but most of the time, the first check mark is let's spend sufficient time with the founders, and is this somebody we actually want to partner with and
Uh,
get married to? So that's a huge piece of the equation. Another like highly relevant piece of the equation that should be, it's obvious, but it can't be, mistaken. There's a lot of these businesses that have scaled quickly, have great financial profiles, but if they're in food and bev, they might not taste great, and
yeah.
if it's in, like, personal care, VMS, or beauty, it might not be that efficacious, but it might have an unbelievable profile, and
Yeah.
we joke about it, but when we're all in Austin, every business that we are considering investing in, we always have at least one day where we bring in all the products, all the competitors,
Yeah.
do a blind taste test or, try to do something that we can determine whether it's efficacious or not, and if it's not efficacious or doesn't taste good, that's sort of like the very first piece of the equation for us, and, you can have great gross margins and an amazing team, but if we don't actually believe ourselves in the business as consumer investors, it is hard for us to get behind that, investment.
I it's funny because, like, at the same time so, like, Nate Cooper will, like, kill me if he hears this, but, like, so Olipop's, like, Series B. So,
I
like,
I was
there
talking to
was
you yesterday, yeah.
yeah, so, like, Olipop's, like, raising their Series B at, like, 2021 or something, and I was like, "Oh, this Olipop thing is, like, interesting." Somebody, like, offered me, like, a small piece, and I was like, I'm gonna go to Target and, like, pick up an Olipop and, like,
Yeah.
try it." And I picked it up and I hated it, and then so I was like, "I'm not gonna invest."
Yeah, but
Um,
to your point, Drew, it's so funny because that's a relatively common occurrence, and that's why we always have, like,
that's what I'm saying, like, my taste
5 or
buds cost
6
me
5 or
yeah.
6 females, 5 or 6 males, different ages, like because there's a
Yeah.
several scenarios, including a recent deal where it was split between Astō on whether the taste was good or not, so,
Oh, really?
yeah, yeah.
What do you do in that case if it's split?
In this particular case, for other reasons and that combined, we ended up passing on it. But
Okay.
I think it ultimately becomes down to if there is an if it's split, usually that says like, all right, there's enough interest here. If the majority, or close to the majority of America's representation and it's a good
Yeah, true.
profile, you're like, all right, so this is for someone.
Yeah, fair
Might be
enough.
for me, but it's for someone. So yeah.
Okay, so we care about the person, obviously, we care about the product from, like, a channel mix perspective or a unit economic
Yeah.
perspective, like, what other sort
Yeah.
of point can you give us?
We're I'd say we're more than ever open to helping businesses if they're very strong online. Our bread and butter is getting you into the right retail accounts with the
Mhm.
right, metrics in terms of like the unit economics there. And if you're really strong at retail but don't know the first thing on Amazon or D2C, that's a muscle that we have now as well, just having dealt with, 10
Yeah.
businesses in that space. So I think we're as strong as any, firm with respect to taking one retail and getting into, taking one channel and getting into the other channel.
Mhm.
So at this point, I say we're agnostic with respect to like channel mix. I do think generally speaking with our stage, if you don't have any sort of opportunity to substantiate retail, it's very difficult to exit these days. So more commonly than not, we are helping businesses get into, a Target or a Walmart, or maybe they're having difficulty getting into Costco
Yeah.
or Sam's. So I do find that like businesses that scale the quickest these days are the ones that are doing really well on Amazon and D2C, and often those are the ones that need more help getting into retail. So that does feel like the sweet spot today.
Yeah.
Skin Club was a great example. When we first invested, they just got their Target business up and running, and
Mhm.
fast forward 2 years, it's the number 2, highest velocity product on in the aisle, behind Neutrogena.
Really.
So,
Jesus.
done really well and right in our thesis.
I Yeah, like, I talk to a lot of investors where it's like they like need retail proof. Like it's like a criteria.
Yeah.
And I'm kinda like, "Okay, but, like, if I grow my business to 50 million of revenue and then I start, like, ripping through Target, like, you're like, I just maybe I'm wrong here, but I feel like that's like the in my opinion, like, one of the best risks that I would like to be compensated for is, like, if this brand is doing 5 million a month on Amazon, like, it's probably gonna do okay in Target, or at least I should be able to underwrite that to a certain extent.
Yes.
But it seems
Yeah,
like a lot of people are wary of that. Like, why do you think that is,
it's
honestly?
it's, it's the world we live in today where no matter how much you harp on the fact that, like, Amazon should be viewed as a customer, not a channel, the same way, Amazon's competing against Target or Walmart,
Mhm.
it does seem like strategics still value, above all, performance at retail because they understand that best. I would say fundamentally, we would tell you our criteria is we like at least 1 or 2 data points at, retail. But in practice, there's businesses that are doing so fantastically well with just the online channel, and the
Yeah.
analysis is so strong that in your gut, like, this is
Right.
carry over. And, like, Clean Skin Club was a perfect example. So,
Yeah, exactly.
we would tell you we need a retail data point, and 95% of the time that's true, but there are certain businesses, products, brands that have done so well on Amazon or D2C that
Yeah.
you don't wanna say it's a given, but you can see the writing on the wall,
It's worth betting on.
it's worth betting on. And that's actually full circle. That also, I think, is an underrated place where there is still alpha. Um,
That's exactly what I'm saying. That's where the alpha
exactly.
is. Because
That's what
like,
alpha
as
is.
soon as I'm doing 2 million a month in retail, or
Everybody
whatever.
knows about it.
Yeah,
No,
and like, okay, now my price is 50% higher. Like,
exactly, exactly.
so like,
Yeah, and, like, to your point, there's a business that I won't say by name, but, like, I would argue we missed the boat on it because we didn't feel like, we could do it without substantiation at retail, and now they're crushing it at Target.
I've seen so we have so many brands. A lot of our brands are like mostly online, but I've seen 15 or 25 of them at this point where it's like they go into Target, they go into Costco, they go into Walmart, they go into Ulta, Sephora, whatever. And at one point they were raising money and I introduced them to a bunch of people and they were like, "Well, they're not in retail." And I'm like, "Well, watch what's going to
There's
happen here because I've
Yeah.
seen this like 6 times now." You could have gotten in at at literally a quarter of the price, but here we are 2 years later, and, it's insane.
And also, like, it's something that I've thought about a lot more recently is as investors who pride themselves on helping brands get into the right retailers, build out the right SKU architecture, the pricing. If you're not at
Yeah.
retail, it shouldn't scare me because that's theoretically what we're best at. So I think it's come
Yeah.
full circle with us too, because there's a lot of these brands. Like the pet space, for example, is one that comes to mind. I can think of a half dozen brands that have scaled rapidly online that have yet
Mhm.
to crack the code at retail. And we're constantly juggling, are we the investors who take the chance, maybe perhaps get the discount on valuation, and
Right.
now we get you into the right retail accounts. Like, we get you into Walmart or PetSmart or, Petco. So, like, it's a great point by you, and I think each category is its own beast, but, certain categories, you gotta take a chance on a
Yeah.
brand online and take it to retail.
That's my personal probably risk profile. I mean, I get, like, why people wanna see it, but, in any regard, it's clear you guys retail hopefully, but not necessarily, I guess.
Yeah, I say, like I said, not 90% of the time, but there are that 10% where often where you find the largest alpha too, so.
And then, so, like, if you are looking at, like, a brand that's, like, mostly online, you mentioned, like, the cohort analytics side of
Mhm.
things, but, like and I remember pitching you guys back when I was running Mad
Yes,
Rabbit, so
yeah.
I might know the answer to this, but, tell me a little bit about, like, if I am a brand and I don't have retail yet, like, what are the things that the buy side's gonna be kinda digging into, and what should I be
Yeah.
ready to talk about?
Yeah, I think every firm's different, like, something we pride ourselves on, we have our own and this will resonate with you given what you're doing today, in terms of the finance side with Iris, but we probably have a database internally where we can benchmark by category at least 100 brands in terms of their
Oh, cool.
cohort analysis. So we got everything tracked with, like, LTV, CAC, AOV, retention, by category, by brand.
Oh,
Obviously,
very
highly proprietary and confidential, don't share it with anybody ever. So it's pretty easy for us to quickly understand whether it's Mad Rabbit as an example, like, you guys have pretty strong metrics, but we could also benchmark that against other brands that are in, like,
right,
category or subcategory, and like I said, I'll just keep using Clean Skin Club as an example. That was like a top decile cohort analysis,
yeah,
and it doesn't wouldn't surprise anybody, while the AOV on that business might not be that high, 19.99, $20, maybe with some bundling, it's 30. The retention and the stickiness of the product is
mhm,
next level because people are using these face towels on a recurring basis, and it's just such a sticky business. Once you start using towels as part of your skincare routine, you come back every month. So,
yeah.
I would say, like, saying nothing novel, but there's such a difference between some of the businesses that have extremely high AOV, and the, retention might not be quite as high just because of the nature of the product.
Well, this is what I was gonna ask you.
And then there's the
Uh
sticky businesses with lower AOV, and we're open to both. Like, there's a business we're looking at right
yeah,
now, extremely high price point. Maybe there's only, like, 1 or 2, maybe you have someone come back and buy it once or twice a year, but the
and then
price point's extremely high. So, we're ultimately looking at the unit economics, and if we feel like this
right.
business has the right, profitability margins in the long run.
And I think that I was gonna sort of that was gonna be my next question because it's like I would argue in many, many cases, and like a brand like Hexclad comes
Yeah.
to mind,
Mhm.
where it's like and they have so many products now that like maybe their retention's you know, not such like a durable, but like in general, like I would expect that their, products are not purchased several times a quarter or something.
Exactly.
So like and I think I might have tweeted this, like, semi recently, but, like, everyone's so focused on retention, and, maybe I'm, like, wrong here from, like, a sheer, like, just, like, market and, like, sort of, like, gross margin perspective, but, like, essentially, I would rather have 1 purchase of $500 than, 5 purchases of $40, all else equal. Like, how is that the right way to think about it? Or is it more like because you only get 1 purchase, you have to pay for every purchase, and so it comes down to, like, contribution? Or, like, what's the thinking there?
In my opinion, and I'm not saying I'm the end all be all here, I think either model can work. Obviously, depends on category, but to your point, the businesses that have high AOV but lower retention, I think they do a better job of proliferating new innovation products into other channels as well.
Yeah.
If you're just a straight up D2C Amazon business, D2C call it, and, high AOV, but there's no retention, like, that's a tough model. Like, at the
Okay.
end of the day, an investor's gonna have, difficulty. I think if your retention is not as high, as other businesses, you need to be an innovation factory, probably have more SKUs, or have the opportunity to get your product out in other, channels such that just one way to buy that product is online, and the cohort
Right.
analysis is not as large of the pie when you're looking at why you invest in the business, and
Mhm.
we've seen that firsthand. We've seen businesses also, I mean, again, full circle here, some of the better businesses we've invested in, some that come to mind that have done extremely well with omni-channel, Physician's Choice, Bloom,
Mhm.
irrespective of, like, the granular details of their cohort analyses, and they're both very strong online businesses, it's become less and less part of the equation for us because they've done so well at retail. So,
Right.
I think in the early stages, of looking at businesses that are only online, I think you hit it on the head, it can sometimes be, tough to analyze, retention if AOV is high and the product has great margins, but, our like, base case model 3, 4 years out, we're always gonna say, at some point, there's a ceiling on how much you can sell online, and
Yeah.
we don't care about the retention anymore online in some ways. Like, you can only grab so many online customers, eventually, if it's a good business, it's gonna be selling at Target, Walmart, club.
Yeah, yeah. And, like, I think it's that, and then it's also just you disregard whether it's, like, online, retail, whatever, but, like, if you're not gonna have, like, a ton of repeat, you have to have such a big market because you're gonna acquire, like, 1,000,000 customers every however often, it's like you're gonna run out of people. So, I do get, like, the counter argument of, like, less customers buying more, like, revenue's, like, a little bit more stable, a little bit more predictable, etcetera. Um, but I do think there's everyone's so obsessed about, like, retention and LTV to CAC, and it's like, okay, but, like, if we boil down LTV to CAC on, like, this one purchase, like, it's 5x, so,
Yep.
like, does that not roll?
T totally, totally.
So I give you guys, like, a fair bit of credit, honestly, just from, like, a flexibility standpoint as far as, like, how are you looking at the businesses, like, what types of deals are you, willing to do? Um, I think maybe another sort of, like, line of questioning would be, like, because you're so and, like, for tell me if you don't agree with this, but, like, because you're so, like, flexible and sort of broad, like, what do the deals kinda look like that you guys are doing? Like, are they hugely different in many regards with, like, pricing and structure and check size, or, like, do you kinda have a playbook for that? Or, like, what I'm trying
Yeah,
to get at is, like,
I think
as a founder, like,
yeah.
how can we think about, like, the types of deals that may be available to us?
I think you actually hit it on the head. I think what one thing that makes us interesting and unique is we have a playbook for every type of deal. So
Yeah.
we like partnering with other funds. So I'd say like 80% of our deals we've done it with someone else, or there's been existing VCs that have rolled.
Right.
So I think generally speaking, like we don't need to grab a whole round, which gives us the flexibility sometimes to write a 30, $40 million check. And then other times with co-invest, we can go above 100 million plus.
Yeah.
And fundamentally, that also allows us to play across kinda like all different types of the investment opportunities. So,
Right.
I mean, to your point, I again, whether this is right or wrong, I rarely turn down any intros because either it's gonna develop into something over the next 2 years,
Mhm.
or there's still a way for us to get involved, even if it's a little earlier stage or later stage than we would typically expect, because ultimately, we as investors are solving for alpha, and I think with our
Yeah.
network and our Rolodex, we're equally inclined to go into some of these later stage businesses, if we can just carve ourselves in at, like, a secondary discount,
Right.
and or we could get in on some of the earlier stage businesses if we see alpha and we feel like we can underwrite, the retail playbook like we talked to back in earlier in this conversation.
Right.
So, um, all that being said, in summary, I would say, like, we're not gonna write anything less than a $25 million check, so
Okay.
one place we aren't playing, founders shouldn't expect us to they shouldn't pick up the phone and ask us to write, a $5 to $10 million check into a business that's still burning,
Yeah.
significantly and is doing, like, 25 to 50 million in sales. We would love to talk to them, but you're just not gonna it's not our stage.
Yeah, 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 yeah. And then what's like if that's the low end, then, like, is there where would you guys top out?
It's a it's a constantly changing question because at the
Yeah.
end of the day, we're in the business of delivering, high IRR and good MOIC. We've dabbled with situations where it's, like, truly late stage and private equity would jump in, and we would just carve
Yeah.
ourselves into it, and I could think of 2 or 3 situations where we've actually had phone calls from private equity firms that are writing $200 million checks, and because of our expertise in that category, they've said, "Hey, can we carve you in for 50 million?" And that would be, getting involved with a partner at the
Yeah.
PO. So, I wouldn't say there's anything that's off the table even on the later stage. Now, you're not gonna see us, wedging in 3 months, 6 months before, business goes public, like, we're not in the business
Mhm.
doing that, but, we could certainly get involved in sort of these, like, later stage private equity deals, especially if we're valued
Yeah.
and there's a proper, horizon to underwrite, call it 3, 4 years.
So you mentioned, going public 3 times now, I think. Um, Once Upon a Farm recently went public. I don't know if there's anything else recently. I should know that probably better than anybody, but how are you how are you, Ray, who's has anybody gone public lately besides
No,
Once
that's
Upon a
been
Farm?
I mean,
Is that the only
I'm
one?
sure you're getting at this, Drew, but, like, that was a huge deal
Right, yeah.
just in general. It was just nice to unlock the window for CPG.
Totally, totally. So, like, I'm glad that we're having this conversation now because I wanna hear, like, does that like, how do you think about, exit liquidity? Is it 85%, sort of platform or strategic? Like, tell me, how do you guys think about that generally? And then do you have any opinion or outlook or commentary around the public markets, like,
Well,
as a potential, exit
yeah,
for brand?
it's a great point, to bring up. I think, like, since COVID, honestly, the public market window for CPG especially
Literally,
has been
yeah.
closed.
Yeah, it's brutal.
And, we've because of our background, Brian obviously working with a publicly traded business, he knows how to take a business public, and he knows what it looks like to run, a publicly traded
Mhm.
business. I think that's a piece of the playbook that we understand better than anybody, and Once Upon a Farm was awesome to see get priced
Yeah,
and trade up. Um, it allows the broader institutional investing markets to see that CPG is relevant, and if you have the right profile, it's a really good buy at the right price. So I think now more than ever, you hit upon it earlier today. There's a lot of these large businesses. You mentioned Alibaba, like, in our portfolio, we've got a couple different businesses that are scaled platforms that,
mhm,
easily have the profile to go public.
right,
I think for a long time, nobody ever bet on it because it just felt like the IPO market was fickle and you weren't gonna get
yeah,
rewarded, and there was also a lot of scenarios, in the background of, D2C consumer brands that were
right,
poor public stories. I think now more than ever, um, with the right unit economics and the right, profit margins, you're seeing these CPG businesses, and a few of them come to mind in our portfolio that have the opportunity to go public. And almost to keep it back pocket because
yeah,
it seems to me like in CPG, there's always gonna be the Pepsi, the Coke, the
mhm,
large strategic, the General Mills of the world that would prefer to just grab the innovator and to be disruptive to their legacy player, so they
yeah,
can grab that growth. So it does feel like it's rare that you see a business come to fruition and go public because there's always going to be the strategic trying to grab that growth in the aisle. Um,
yeah,
but in my opinion, the Once Upon a Farm story is unique and interesting because, um, it's a business that was, not necessarily an overnight success. It's been a long time coming, but they've developed and built that business in a way that it was able to go public given its unit economics, its SKU array, its platform, and its opportunity to move into, like, very interesting categories where there is growth. And I think whether it's beverage or VMS, there's a couple different brands out there that are ripe for, a public entrance, and they have the right profile.
yeah. It so I graduated college in 2019, so I was almost, like, a little bit late from the standpoint of, like, it was kinda COVID, like, right away for me, when I was and I covered, equity capital like, public
Yeah.
markets,
So wow. Yeah.
yeah, so, like, I graduated, and then all of a sudden, I did, like, a career's worth of IPOs on a research desk in, like, 18 months.
I believe that.
Uh,
I believe
So, like, I was like, "Wow, this is awesome, like, we're all making money, like, this is a ton of fun." And then, 4 or 5 years later, it's like, "Wow, that hasn't happened, in 5 years." Like, Do you feel like it's a cycle and like we may slowly be coming back, or like like what's sort of the like does it change the way that you think about investing in companies? Like, hey, we could actually go public with this thing. Like,
Yeah. Oh my
how
god,
does
yeah,
it influence like your
totally.
philosophy?
I mean, you hit it on the head. It's like the opportunity to have the public market be a scenario where you could potentially exit via an IPO at our stage de-risks a lot of the
Yeah,
investment opportunities because we actually are investing in businesses that could quickly scale to the point where there's only, a handful of strategics that could pick it up at the
yeah,
valuation we're hoping to underwrite. So
yeah,
just
yeah,
very succinctly and clearly, the answer is yes. I mean, there's 3 or 4 businesses we've invested in where we have the right profile, in the next 2 to 3 years, I believe, to go public if we felt like that was the right move. The bigger question, honestly, is as you evaluate these businesses, does the management team have the right muscle, slash skill
yeah,
to be publicly traded,
yeah. I mean,
right?
it's completely different.
But, I go back to it, like, that's where we come into play. We've seen businesses that have gone public, we've been part of them, and we do understand, like, what a public company CFO looks like, and
Mhm.
is the CEO, interested in, moving forward and being a publicly traded CEO? So, I think now more than ever, it actually helps us underwrite these deals, especially when we're paying, higher numbers based off
Yeah,
the business is, more scaled. And yeah, each category is different, but there's some really unique ones out there. I wouldn't be surprised this year to see, another half dozen CPG IPOs.
really, half a dozen,
Half a dozen, yeah.
half a dozen.
I
Right, write
you
that
can
down.
think
You
of a
heard it
few
here.
off the top of my head, without disclosing it.
Uh, okay, so I mean, that would be epic. I would love that. Um, when you so like what does it take then, I guess, to do that? Like you mentioned that like there's a couple that you are like could at least could think of that like have the profile. Like Once Upon a Farm was like 200 million of revenue.
Yeah,
Like
relatively small, honestly.
yeah, like it's not like you need to be like $1 billion
Yeah.
grower.
No, no. I mean, you've gotta have, like listen, like, Once Upon a Farm was a great, barometer. They were priced correctly.
Yeah.
It traded up. They had the right people behind it to take it public, really strong investor base, the right bankers. And I think, like I said, they also have the right brand that it can if you're an institutional investor, you're on the ECM desk, you can now understand, like, "All right, this is what this business is doing. They've turned the corner on profitability. They've got, like, a really nice category they're playing in that has underlying, tailwinds."
Mhm.
And I think, like, you could play that story out in a million different ways. Like, you even look
Yeah.
at, like, you look at some of, like, the beverage businesses out there, just in general, like, I think those have done really well in the public markets, right? So you look at, like,
Yeah.
Alani Nu, post-deal, and those businesses have traded up. So I think, like, if you look at the current publicly traded businesses in CPG and use that as sort of like a way to get a sense for what else could be, on the come, I
Yeah.
think that's the best proxy for what the market's rewarding in the public markets. And back to your point, like, I would make an argument that, like, at certain scale, it doesn't make sense to go public, and, Once Upon a Farm may have been just on that inflection point and cuff where you're like, "Is this too small or not?"
Yeah.
They were ultimately, able to turn the corner, and I think it actually was a great deal, but, yeah, I mean, most of these businesses that go public, I think are at least 200, but, you're seeing businesses that are closer to, like, 400, 500 top line.
Yeah, like what's like Once Upon a Farm, what's their market cap at this point? It's gonna be like 700, 800 million.
Mhm. So, like, to your point, like, anything
Yeah.
under $1 billion in market cap, I think that's where you start, questioning, there's so many different layers to being public and all the different, expenses and costs that
Right.
go along with being a publicly traded business. So, yeah, I think, like, they're right on the edge, but I actually would say it was nice to see a business that was,
It's great. I
arguably
mean, look, like
smaller to go public,
sub a billion market cap, like one to this is what it used to be. This
Exactly.
is like what this is the point. Like you get into Once Upon a Farm at 5 or 600 million or whatever, and like in 15 years it's a $5 billion company or whatever, and like
Right.
the like the inflation of the availability of private capital. Many would argue has robbed a lot of the public in terms of participating in the growth of these companies, and so I think like this market should, I hope, come back like this like sort of like I guess technically it's like maybe like micro-y, but like
Market
like
cap, yeah.
Prenetics is a VMS brand that
Mhm.
they own. The IM8 company. I had Danny on the show, and it's like their market cap's like 300 million, but like that stock's been doing great because it's a great company and like they just happen to be public, and you don't have to be a $5 billion thing. So I personally would love to see this come back, and I think it would just kind of flow downstream to the rest of the
I
stack, and like
I agree, and to your point, the ripple effect, and I totally agree with you, I hope to keep seeing this as well. The ripple effect too is you get some of these new up and coming, CPG high flyers that go public, they become platforms to then make acquisitions, and I think that is something that we would all benefit drastically from because, every day you read something about Kraft Heinz or like, what's going on there, right? So, like, just to have, like, a larger group of publicly traded businesses and, like, the better for you platforms of the world that can be acquisitive, it will be awesome for CPG.
and it's just it's I almost like I almost sold the bottom of this industry when I left, but like it feels like I said, like for the last like 5 years, like this wasn't even like a thing, but now all of a sudden doesn't really feel so far to reach. So maybe, maybe you're right. Maybe there'll be six more this year, and
Yeah.
um people will start to get a little bit more excited, and
And by the way, to your point, the last thing I'd say on it is if there is, knock on wood, half a dozen additional IPOs out there, there's such a ripple effect too of liquidity flowing to everybody in CPG,
yeah.
right? And like whether it's investors, whether it's really sharp operators that have now made money, and like that allows the entire ecosystem to be better off when everyone kind of
And
understands.
they can all buy more Iris subscriptions at
Yes,
the end of
exactly.
the
There you
day.
go. We eventually needed to get right back to the Iris.
This is why I want the public markets to open up, is so that people can buy more Irish subscriptions.
Exactly.
All right, Robbie, before we wrap up here, I have one question. I think I've asked this to all of the investors on the show. So because like I mean, these guys like they see so many different types of companies and deals. And I think about the answer to this. Like, if you were gonna start a brand tomorrow, like what category, what it look? Because I know you've thought about it.
Yeah, it's funny, like, I could answer this question in so many ways that are very
Uh-huh.
investory, right? But it truthfully, I have the biggest sweet tooth of anybody I know.
Okay.
D Whether people would say this was smart or not, given, like
Candy?
I would do something that's either in, like, confection or candy,
Okay.
possibly even, in the frozen space. I love cookies and cookie dough, and there's a couple of I know it sounds hilarious, and it's tough margins, but
I wasn't This is not what I was expecting you to say.
you were not expecting this at all because I thought the easier answer would have been something with really high gross margins, but I
I
think
thought you
that
were gonna say like a supplement or something. Yeah.
of course, but that's so over-indexed today.
Yeah.
If you truly ask me and what I think I'd be passionate about and be able to actually, like, deliver, like, alpha, I would do something that's good nutritional panel, but sweet. I think, like, there's not enough
Okay.
indulgences,
So better
but
for
also
Robbie's
better
better for you frozen cookie dough.
exactly, something like
You heard it here first. All right. And then okay, last thing, Robbie. If folks want to get in touch with you guys, what's the best way to do so?
Yeah, we're pretty easy to get in touch with. So on our website, Astō Consumer Partners, we've got our emails on there. So I think it's pretty easy to just click on any one of us and get in touch with us there. But if I'm wrong on that, um, you can just reach out to us at
I think you might be wrong, at least in my opinion, because when you go to the Astō
okay,
website, I always so like there's this button that says enter.
got it.
You know what I'm talking about?
We've been rejiggering the website, so
So I always thought that the enter was gonna be like one of those LP logins. So
Mm,
I never once clicked it.
got it,
But
got it.
then I clicked it, and so now I can see everybody. So if you want
Oh,
to get in
yeah,
touch
I
with
guess you're
Robbie,
right. Yeah. I guess,
yeah,
we actually are updating the website as we speak. As you guys can tell, like, we're a little bit, slow to get the news out on Asto, but yeah, that looks like there's a contact us page. In the coming weeks, we're gonna have a revamped website where we'll actually have everyone's email. So I think still the best and easiest way to reach out to us will be
yeah, new
to
fun, new website.
new website. We do have a contact us, little sub button, but yeah, keep an eye out over the next couple weeks, and um, you know, that should be pretty easy to get in touch with us.
Cool. All right. Well, AstroConsumer.com, Robbie Patterson, everybody. Thank you for joining us, Robbie.
Thanks, Drew. Appreciate it.